Hey everyone, Adam Simmons here from Dgtl Infra, short for Digital Infrastructure. It has been incredible to see the next generation of data centers being built through M&A. In this video, I'm going to give you a quick overview of the rationale for DataBank acquiring zColo, what the combined footprint of the new company will look like, and how it all ties in to the broader data center environment, including technological innovations such as 5G technology. I will link to important takeaways from this video down below. After watching this video, you will have a better understanding of the implications of 5G on data centers, so stay tuned and I'll break this all down for you. Before I do, be sure to subscribe to the Dgtl Infra channel and turn on the notifications so you don't miss my next in-depth video that is coming out soon. Now, let's jump into the video. Zayo, which is the parent company of zColo, owns 133,000 fiber route miles, 13 million fiber strand miles, which are connected to 35,000 buildings in the United States and Europe. In addition, it owns the 44 zColo data centers in its data center segment. DataBank, the acquirer, operates 20 data centers representing 54 megawatts of power capacity and 457,000 square feet in the United States. Now, with those profiles in mind, let's jump into the transaction. Zayo announced that it had agreed to sell zColo, which includes 44 data centers, 13 key interconnect locations, also known as carrier hotels, in 23 markets across the United States and Europe, to DataBank for $1.4 billion. After deducting for capital lease and other purchase liability adjustments, zColo's enterprise value is $1.2 billion, which equates to 14.2 times zColo's Q2 2020 annualized EBITDA of $86 million. DataBank will own and manage the data centers in which Zayo will remain a key anchor customer to provide network connectivity solutions for its customers. Furthermore, the companies will collaborate closely in bringing colocation solutions to Zayo's fiber customers and network connectivity solutions to DataBank's colocation and cloud customers. The sale of zColo, which is anticipated to close by year-end 2020, allows Zayo to take a material step in its path to focus on its core fiber business. For DataBank, this transaction combines the broad collection of zColo's data centers and network interconnection assets with DataBank's 20 data centers, 5 key interconnect locations, or carrier hotels, in 9 markets which are focused on Tier 2 cities. With the acquisition of zColo, DataBank emerges as a leading United States edge colocation operator for hyperscale technology and content customers. zColo adds a diverse mix of strategically important enterprise and interconnect data centers across attractive new markets. Now let's take a look at the combined footprint for both DataBank and zColo. As you can see from the map, the dark blue circles represent DataBank's assets, and the orange circles zColo's. The enlarged portfolio will consist of 64 data centers in 29 markets, up from 20 data centers and 9 markets for DataBank prior to the transaction. In total, the company will have 3,000 customers, including many Fortune 100 and leading cloud and content providers. Revenue-wise, the company will have over $450 million and EBITDA of over $150 million. In terms of size, if we think from operational metrics, the company will have 1.2 million square feet of data center space and generate 138 megawatts of power capacity. What's important here as well are the cross connects, and the combined company will have 30,000 of those. There are 18 major network interconnection points throughout this portfolio. These are data center facilities that are located in some of the most important carrier hotels in North America, and I'll give you a few examples of those now. In New York, 60 Hudson Street and 111 8th Avenue are both inside of Digital Realty facilities where Zayo operates. Zayo has the exclusive right to operate and provide co-location and interconnection offerings in the Meet Me Room at 60 Hudson Street. Another example is 1950 North Stemmons Freeway, which is an Equinix facility in Dallas, and 2323 Bryan Street, also in Dallas, which is a Digital Realty facility. In Seattle, at 2001 6th Street, which is a Digital Realty facility, is another major interconnection point. And in Toronto, at 151 Front Street, which is owned by Allied Properties, is a further interconnection point. Finally, the portfolio will have access to 12 cloud nodes, which are connections to some of the major cloud providers. If we take Microsoft Azure ExpressRoute as an example, the combined portfolio will have access to Chicago, Dallas, London, Los Angeles, New York, Silicon Valley, Toronto, and Washington, D.C. through that Microsoft Azure ExpressRoute connection. All right, so now let's dive into some of the numbers of the transaction. As you can see on the bottom right side, the purchase price for the transaction is $1.4 billion. And after deducting for $185 million of capital lease and other purchase liability adjustments, the adjusted enterprise value is $1.2 billion, which on $86 million of zColo second quarter 2020 annualized adjusted EBITDA equates to a EBITDA multiple of 14.2 times. If you go up to the capitalization side, we can take a look at how the transaction is being funded. The transaction is being funded with an equity investment of $720 million by an investor group led by Colony Capital, which trades on the New York Stock Exchange under the ticker CLNY. Colony is DataBank's controlling shareholder, along with Nuveen Real Estate. Looking historically, Colony Capital originally invested in DataBank in January 2020, purchasing a 20% stake in the company valued at $185 million, which equates to approximately 17.6 times EBITDA at the time. As part of the zColo transaction, Colony Capital is investing an additional $145 million from its balance sheet to maintain its 20% ownership stake in DataBank, which brings Colony Capital's total investment in DataBank to $330 million. The remaining equity investment of $575 million for the zColo transaction will be provided by third-party co-investors, adding more fee-earning equity under management, also known as FEEUM or FEUM, for Colony Capital. The acquisition debt financing of $550 million for the transaction is being provided by TD Bank, Truist Financial, and SocGen, or Société Générale. The total debt of the transaction rises to $725 million when including the capital lease obligations. zColo, which was valued at 14.2 times EBITDA, represents an accretive transaction multiple relative to Colony Capital's initial investment in DataBank, which was valued at 17.6 times EBITDA. Additionally, the zColo transaction compares favorably to publicly traded data center peer valuations, including Equinix, which trades at 33 times 2020 estimated EBITDA, Digital Realty, which trades at 26.5 times 2020 estimated EBITDA, CyrusOne, which trades at 23.5 times 2020 estimated EBITDA, and CoreSite, which trades at 25 times 2020 estimated EBITDA. As a side note, you can sign up for our weekly email updates at DgtLInfra.com to receive the latest publicly traded data center peer valuations straight to your inbox every week. Finally, in terms of precedent data center transactions, the zColo transaction multiple of 14.2 times EBITDA compares favorably to historical data center M&A during 2020. Let's walk through 3 relevant examples now. In April 2020, Macquarie Infrastructure acquired AirTrunk from Goldman Sachs and TPG Capital for $1.6 billion, equating to a 31 times EBITDA multiple. In March 2020, Digital Realty acquired Interaction for $8.5 billion, equating to a 21.5 times EBITDA multiple. And finally, in February 2020, Digital Realty acquired the remaining 49% interest in the Westin Building Exchange in Seattle for $305 million, equating to an 18 times EBITDA multiple. As another side note, for our full list of Precedent data center transactions, please visit the premium content section at dgtlinfra.com to get full access to our data center transactions dating back to 2015. I wanted to also share this DataBank overview page to give you a sense about how Colony Capital thinks about its EBITDA multiples when it's acquiring both DataBank and now for zColo. So if you look on the right side of the page, you can see that at one time, the acquisition EBITDA multiple was 24 times. The 22 times EBITDA acquisition multiple that you see as a step down represents the implied EBITDA trading multiples of retail colocation based on DataBank's estimates at the time. Further, stepping down to 19 times multiple of EBITDA is a run rate figure based on second quarter 2020 EBITDA. And then further, the 15 times or less than 15 times stabilized EBITDA multiple is what Colony Capital expects DataBank to get to in the future. So over time, you can see that through accretive acquisitions, Colony Capital is effectively buying down its EBITDA multiple. Now, with all that said, synergies and business optimization initiatives will further enhance the economics of the zColo transaction. As I explained, similar to the multiple of DataBank itself, which is expected to have its effective EBITDA multiple reduced to less than 15 times, zColo will have a lower effective multiple on a stabilized basis under Colony Capital's ownership. And then one last thing about this transaction that I wanted to highlight for you in terms of connecting the dots. It's worth noting that Colony Capital, through its Digital Colony Partners 1 fund, also owns a material interest in Zayo, which was taken private in March 2020 alongside EQT Partners in a $14.3 billion transaction. For that transaction, it was funded with about $6.3 billion of sponsor equity and $8 billion of debt. So Colony Capital has additional influence over Zayo, the seller in this transaction, through its $2.2 billion of equity co-investment committed for Zayo, and also has control over DataBank through its equity ownership there. So interesting point to note. Now let's try to frame out how the DataBank and zColo transaction fits in with the broader data center universe of companies. From a broad perspective, you have two major categories of data centers. You have retail and wholesale, as you see at the top of the page. Within retail, you have both interconnection facilities and enterprise facilities. I would say DataBank fits more in the enterprise side of the retail category, but is very much trying to make itself an interconnection-focused retail play, as highlighted in their presentation. If you want to think about where DataBank wants to go, it would be the Equinix 2.0. So let's dive into some of these subsectors in a bit more detail to provide you a bit of color on how to think about the different types of data centers. So retail data centers as a category are third-party organizations that are multi-tenant accessible, meaning that multiple businesses of any size or industry can house their equipment within that data center. Companies of all types and sizes, from small and medium-sized businesses to Fortune 500 firms, use retail data centers. These retail data centers serve the needs of corporate IT departments and large-scale internet enterprises. Customers who use retail data centers have smaller power requirements and require help to manage their equipment that reside in those data centers. Within the retail category, the first is interconnection. So what is interconnection? Data center interconnection is a business involving connecting various tenants within the same multi-tenant data center to each other and charging a recurring fee for that cross-connect, usually charged on a monthly basis. Cloud customers, think Amazon Web Services and Google Cloud, generally connect to numerous different counterparts within that multi-tenant data center. Interconnection is vitally important to retail data center providers as data integration, points of presence, known as POPs, cross-connection, and low latency capabilities become even larger priorities for enterprises in the future. The typical customers for an interconnection-focused retail facility are digital media providers such as Akamai, Netflix, and Hulu, and financial companies like Dow Jones and the CME, or Chicago Mercantile Exchange. Moving to the enterprise side, these facilities are focused on legacy business enterprises and managing private cloud workloads. There are a few different strategies that enterprise data centers focus on. They tend to target Tier 2 and Tier 3 data center markets, and they can offer additional ancillary services such as cybersecurity with colocation services, web hosting, and connectivity that are packaged together for customer deployments. Typical enterprise customers are those large Fortune 500 companies that we all know, like Exxon, Gap, Walmart, and United Health. In terms of some of the other operational metrics, interconnection and enterprises are priced and leased in a similar way. Deployment sizes typically max out at 500 kilowatts. Contract length averages about 1 to 3 years. And customers are typically charged between $400 and $900 per kilowatt on a monthly basis. Moving to the right half of the page, wholesale data centers can be categorized into 3 main subgroups. You have wholesale, hyperscale, and build-to-suit. Let's just talk generally about wholesale for a moment. These type of data centers differ from retail because they provide space, power, and cooling to run large-scale computing and storage deployments for their customers. The tenants are the large internet and cloud companies that own and operate their network equipment. Space and power are leased in larger capacities than in retail data centers, and as such, typically house fewer customers per facility. The concept here is similar to leasing a warehouse or office space in which the landlord provides facility maintenance to the tenant. If we think about the wholesale subsector within the broader wholesale grouping, these facilities provide private suites and large cages for their tenants. Shifting to hyperscale, this is where a company rents out an entire facility for its own dedicated use. The customers in these type of facilities can be thought of as follows. You have cloud service providers like Amazon Web Services, Microsoft Azure, and Google Cloud. You have internet companies like Facebook, Uber, Twitter, Netflix, and Apple. And then you have emerging technological companies like a Dropbox, Spotify, and Snapchat that also use these facilities. Finally, the rightmost column, build-to-suit, is where a company rents out an entire facility for its own dedicated use. These facilities offer more control over design space than a standard facility, but still require a large commitment in terms of energy use and overall expenses. As you can see, as the data center becomes more bespoke as we move from left to right on the wholesale spectrum, the deployment size moves from a max of 2 megawatts to over 20 megawatts for build-to-suit. When customers have larger deployment sizes, that typically coincides with longer lease durations. As you can see, the contract length for the wholesale category is 3 to 5 years and steps up to 10 to 15 years for both hyperscale and build-to-suit facilities. In terms of pricing, the wholesale category in general compared to retail is priced much lower on a per kilowatt basis, at $150 per kilowatt on a monthly basis, and that includes no power. Finally, one of the most fundamental technological innovations that is forthcoming is 5G. And this has tremendous implications on the data center space and is relevant to think about in the context of the acquisition of zColo by DataBank. 5G is expected to drive a sizable increase in the amount of data that is computed and stored that will ultimately require data center capacity. This is because many of the anticipated 5G solutions will rely on sensors and devices that have been deployed to collect data that will then send that data back to a cloud platform, which is another term for a large data center. With the larger amounts of data created as a result of 5G, data centers provide central locations for using technology such as artificial intelligence and machine learning to harness the data to create new use cases such as autonomous driving. 5G will represent another growth engine for cloud demand that is more industrial and targeted than those use cases thus far, which have been much more consumer and broad-focused. In a 5G environment, more data and processing requirements may move closer to the network edge as carriers seek to fulfill ultra-low latency needs. And you can see that in the image here. The data center on the top half of the page in blue is signified for aggregation and transport and has a latency of 2 to 3 milliseconds. When you move to the bottom half of the page, that data center moves closer to the edge and therefore has a latency of only 1 millisecond. 5G will be the driving force for a new segment of edge data centers that are located physically closer to the end devices that are both creating and then utilizing the data. Think about central offices or at the base of tower cell sites. These facilities will be smaller than today's data centers, but will ultimately outnumber any other form of data centers going forward. The existing data center architectures will remain important as the primary locations for data processing, but the edge will be particularly relevant for reducing latency. And because latency is dependent on the distance of transport, moving that data center closer to the edge in the context of 5G will help facilitate faster data processing. If we think about some of the transaction rationale which we spoke about earlier, DataBank is now characterizing itself as a leading US edge colocation operator for hyperscale technology and content customers. By having a larger DataBank portfolio, the company will be able to serve the expansion of cloud and content workloads into primary and secondary edge markets. So that all ties into part of the rationale for the transaction to take advantage of these 5G and edge computing trends. Hopefully you found this video helpful. If you did, then please share it with somebody you think might also find it helpful, and consider subscribing to DgTL Infra and visit us at dgtlinfra.com for more of the latest news on digital infrastructure. Thank you for watching this video. Be sure to like the video and post in the comments telling me about whether you think DataBank made the right decision to acquire the zColo data centers from Zayo. Thanks again for watching, and I will see you in the next video.